I don't think so. You know, my call has always been that we would see a slow grind higher and melt up inside of the market if people still anticipate that we're getting a cut in July. I think if the FOMC and Jerome Powell, if they stand pat in July, I don't think it'll have too bad of an effect on the market. You may say a little bit more trimming around the edges. As I said at top, we've been overbought in the markets for some time, and you're going to see that pull back. But I think, quite frankly, it begs a larger question. Some of the president's comments are completely incongruous with economic modeling. I mean, if you have a robust economy, then you should be raising rates to actually stem off the tide of potential inflation. What we've seen in the marketplace, however, is that the PCE deflator has been pretty tame. We still move forward. Wage inflation has not really garnered or gained traction in this. So I think it gives a little bit of a wiggle room for the Fed. But the further point, too, is let's be completely candid about where we are in the political cycle. I mean, the White House knows quite well where they are. We're from a general election 16 or 17 months away. And in the modern history of the United States, no incumbent or incumbent party has been voted out of office while the economy is still expanding. If people think we're very long in the tooth and there's potential for a recession in the beginnings of 2020, that's going to be a real problem for his reelection. So they're going to do everything they can to stave that off. Yeah, that's a key stat right there. Terri, where do you fall within this emerging rate debate? Do you think the Fed cuts later this month? And if so, by how much?
Right. I mean, I don't think that the Fed is got the data, as the other guest has said, to cut rates at this point. I mean, the Fed is independent. The U.S. economy is still going strong. The jobs report certainly supported that. We haven't been torpedoed by all these discussions about tariffs and trade talks. And so I think, you know, the Fed cuts when there's a recession on the horizon. And there's 4 horsemen of the apocalypse that we look for that have occurred before every single economic recession. The first being an inverted yield curve, which we do see. But on the other hand, employment is still quite strong. Leading economic indicators are strong. Housing starts are strong. And so we don't see this recession on the horizon. We don't see any horsemen declaring that the end is near. And in that case, the Fed should be staying put at this point.
Terri, that said, so positive view, relatively speaking, on the U.S. economy, but that said, you prefer high-yield bonds in the U.S. than U.S. equities?
Absolutely. I mean, what I think is going on is just a state of confusion. You've got a U.S. stock market that's tapping against all-time highs pretty regularly, and seems to believe that the Fed's going to engineer a very perfect soft landing. And on the other hand, you have the bond market with the 3-month Treasury bill above 2% and the 10-year trying to drop below 2%. That's just not normal. So that says to us that there's a state of confusion. We want to go after return but manage the risk. That means high-yield corporate bonds over equities. It means emerging market debt over emerging market equities. And that's how our portfolios are positioned right now.
You agree with that? Well, I do. And Terry's thesis actually falls in line with what you're saying, Wilf. If you believe there's no recession on the horizon, then you go invest in high-yield bonds. If you're a bond investor and you're a bond player, because then you think that there's going to be there's very little, if any, default risk, and you're going to get rewarded for that, for not being in a recession. But I do think, as an equity player in person, I will say this, is over the longer term horizon, equities have always provided the best return for an investor. And again, if you don't believe that there's going to be a recession anytime soon, and even if the Fed were to hold interest rates steady or nibble or take a scalpel to them and pull them back 25 basis points, then you're right. I think equities is probably the better place to be.